Today I want to talk to you about return on investment. You want to make fat stacks of cash, right? Return on investment is a very simple idea on the surface. How much money, profit will an investment produce, or how much additional capital you're going to get back for the capital that you put in. But like many things in the world, there are nuance and details that can make this calculation way more useful than it seems at first glance. But that nuance can also create confusion, distortion, and be used to produce outright fraud. In this video, I'm going to explain a few different return on investment metrics, starting with the rudimentary simple stuff, and then buckle up because we're going to go deep into some complex stuff. And then I'm going to show you exactly how people on the internet deceive themselves and you by using ROI metrics in an irresponsible way, because the internet is full of charlatans and I feel like it's my responsibility, my personal deep responsibility to point them out. The three metrics that we are going to cover are return on investment, cash on cash return on investment, and the internal rate of return. Let's go. Return on investment is the most simple and the most trustworthy of these metrics. You take an asset or a business and you divide the amount of net income it posts in a given period by the total cost of the deal. For example, I have a house that kicks off $10,000 in net income for the year and the house costs $100,000. That's an ROI of 10%. Dead ass simple, useful, and very difficult for a person to manipulate the numbers to make it look better than it really is, which we will do with the next metric. ROI in its pure form completely removes how you paid for the deal, whether you paid for it in cash, debt, whether you used your money or somebody else's. None of that matters when calculating return on investment. And that's really important when making financial decisions like this. The place makes 10% and I'm okay with 10%. Let's go. Now, I'm going to make this a little simpler than it really is because I want to show you only what you need to understand for the scope of this video, but know that there are important complexities that I'm going to leave out for the sake of time and efficiency. Let's take the same deal I used in the last example. I buy a house for $100,000. With my cash, it kicks off $10,000 a year net income. And that's the same as cash on cash because we're using all cash. So 10% ROI, 10% cash on cash return on investment, all good, right? Yup. Okay, I gotta get a little complicated here. On the next deal, I don't just use my own cash to buy the place. I use a loan for $50,000 and I use $50,000 of my own money. That $50,000 loan comes with mortgage payments and those mortgage payments are gonna be $3,000 a year. My net operating income is the same because mortgage payments are calculated after NOI, but my cash flow, that's after the mortgage payment, is $7,000 a year instead of $10,000 a year because 10,000 minus 3,000 is 7,000. So $7,000 a year net cash flow divided by my $50,000 cash in is a cash on cash return of 14%. 14% is better than 10%, right? It sure is, but that's apples to oranges. My ROI is 10% because the deal still cost me $100,000 and the NOI is still $10,000 per year. My cash on cash return on investment is 14% because we're only counting cash out divided by cash in. If this is not clicking, stick with me a little bit longer. I got you. Okay. Let's bump that mortgage up to $90,000 instead of $50,000. And now my mortgage payment is $5,500 a year. So I have a $90,000 mortgage, but I only had to use $10,000 of my own cash. The net income is still the same as it has been the whole time because the house is still $100,000 total and it still makes $10,000 NOI. But my mortgage is bigger, so my cash flow is less. Instead of $7,000 cash flow, it's only $4,500. I'm making less cash flow per year, but I have way less cash in the deal. In fact, I have disproportionately less cash in the deal than I'm making in payments. That's why debt is called leverage. My $4,500 cash flow divided by my meager $10,000 initial investment cash is a 45% cash on cash return. That's better than 10%, right? Heck yes. Okay, now let's go ahead and put the full $100,000 debt on the property and I have no money invested in the deal. Even with a $7,500 per year mortgage, the property is all cash flow and pure profit. I might only make $2,500 per year in cash flow, but $2,500 a year cash flow divided by zero cash invested is not possible to calculate because you can't divide by zero. This is often referred to as infinite cash on cash return. And just a reminder that traditional ROI metric has still not changed. The deal itself is still a 10% return because ROI is a metric that measures the deal and has nothing to do with how a person paid for it. In each example, we are changing the debt, not the deal. So the ROI has stayed the same, but the cash on cash return is improving. Now here is the big magic trick that I've been prepping you for. You ready? You're not ready. Are you ready? Let's get rid of our 10% deal, the one we paid $100,000 for, that net income's $10,000 a year, the one we've been using the whole time. And let's get a different deal that still costs $100,000, but it only makes me $1,000 per year in net income, a 1% return on investment. For reference, 1% return on investment is a terrible deal. You can buy US Treasury bonds for 3%, and those are what's considered risk-free. And few people do that because you can earn 8% reliably in the stock market. No one wants a 1% ROI deal. I'm gonna go ahead and buy that lousy deal anyways, and I'm gonna put a $100,000 loan on it. And I'm only gonna cash flow $1,200 for the whole year. But guess what? My cash on cash return is infinite because I have nothing in the deal. That's still kicking off that pure profit cash flow, which sounds appealing, right? No. Because the ROI is still a terribly and embarrassingly low 1%. But when you put enough debt on it, you can display it as if it's a great deal. And this is how people lie to themselves and others about their deals. By pushing a cash-on-cash return on investment metric, they can hide shitty deals through misunderstood metrics and convince you that they are good investors. Then you go off and you buy their programs and platforms and whatever other nonsense they want to sell you, or worse, you go to the world and you try to emulate them as if they are good mentors. All of these are bad ideas. Cash-on-cash return is not a good measurement of deal profitability, despite how commonly it's used. It is a measurement of measuring the efficiency of your debt. Is it a useful metric to use and understand? Of course. That's why I made this video. First, so you can properly understand and use this information to your advantage. And second, to protect you against idiots who would use this same information to distort reality in their favor at your expense. Internal rate of return is probably the superior investment metric of them all, but its application is not as universal because in most instances, it can only be properly calculated after an asset has been purchased, kicked off its cash flow for the time that it's owned, and then sold. So if you're looking to buy a stock or rental property and hold on to it forever, IRR isn't as useful. But say you want to buy a business or a property, hold it for 5 years, and then sell it, or say you want to raise money from outside investors to participate in deals like I do, where we sell them in 3 to 5 years, the apartment buildings, then IRR is perfect and powerful. You can't do IRR calculations on a calculator, or it's very difficult because it requires a tricky little process that works off of things called the discount rate and net present value. It doesn't matter. Understanding how to do the equation is not what's most important for this video. I mostly want to explain where it applies and how to apply it. If you want to tinker with IRR calculations and see what they look like, just Google IRR calculator. IRR takes the initial capital you put into a deal, adds the annual cash flows of each year that you own it, and then adds the final cash payout when you sell it and gives you a return on investment metric. In the effort of simplicity, let's say I bought that same original house with my $100,000 cash and no mortgage, and it kicks off $20,000 a year in cash flow. On the 5th year I sell it for $20,000, my IRR is 0. Why? Because that's 4 years at $20,000 a year and a $20,000 exit, or $100,000 total, which is equivalent to my initial investment, $100,000 out, $100,000 in, 0% return. Now, if I paid for that house, made $20,000 a year for 4 years, and then sold it for $150,000, my total payout would be $230,000 over the time, which makes for just over a 23% IRR, which is much better than 0. Carry the two, much better than 0. But as with cash on cash return, there are ways to corrupt the IRR, and it happens all the time. The only pure way to use IRR is when you're looking back on a completed deal that has been sold. That way you know what the initial investment was, you know what the cash flow each per year was, and you know what it sold for. At that point, IRR becomes easy to calculate and dead-ass reliable. It's much worse when speculating about the future. Say you're about to buy a deal and you want to project the future IRR. You know what the initial investment will be, but you have to speculate on the cash flow for each year, which is not super hard, maybe year one, but as the years go by, the ability to accurately predict the market forces and what an asset will kick off in profit becomes weaker and weaker. Do you really know what that thing is going to kick off in 5 years or how much it'll be worth? On a rental property, this isn't that difficult, in part because rentals are highly reliable. But what about the exit price? Back to the last example. I'm going to buy that place for $100,000. I'm going to predict that it'll kick off $20,000 a year for 4 years, and then in year 5, it'll sell for $150,000. That's my 23%, right? But what if I tell my investors that in 5 years, it'll sell for $250,000 instead of $150,000? Now my IRR projection becomes 33%. That's very appealing, but it's completely speculative, and it's very, very far away. What if the market then tanks and the property sells for less than I bought it for? Only $90,000 in that 5 years instead of 150 or 250. Now my IRR is down to 15%, less than half of what I promised my investors. This is a very slippery slope, bro. And this is why it's so important to understand these metrics, because they are useful, but they can also be susceptible to manipulation and deception. I know I said a lot in this video, but let me summarize. You need to understand all three of these metrics to make good investing decisions. None of them are objectively better than others, and they are all useful in combination with each other. Return on investment, the net income divided by the cost of the deal, is the purest metric to calculate how good a deal itself is and the hardest to corrupt. Cash on cash return is best used as a measurement of efficacy of debt, but the most easy to corrupt, because with enough debt, a person can make a horrible deal look better than it really is. And IRR is a great metric for calculating returns on a deal through the whole cycle from purchase to sale, but when using it to calculate future projections of a deal, it becomes highly speculative and subject to a lot of corruption. Whew! Thank you for watching. I wanted this piece to be quick and useful piece of content, but I fear maybe I went a little overboard with the nuance. And we'll have lost people who have 30-second attention spans. So if you made it to the end, I'm incredibly grateful. I love nuance, and so I'm not going to change. If this doesn't earn me a subscribe from you, then I don't think anything will, and I hate you forever. That big red button below, press it.